Hello everybody, welcome to another video, hyper growth stock video, where I try to search and find the next big stock, the stock that is cheap but will not be as cheap in the future. And you know, as I write this video, one of the things that comes to mind is HIMS still seems like one of the biggest opportunities out there. It still feels like it, because with the two stocks that I begin this video with today, LifeMD and HIMS, right? LifeMD and HIMS, I've been into HIMS for now the whole history of the channel. Essentially, LifeMD started covering it in the past, what was it? 8 months, roughly, something like that, and it just went way up, and that's extremely annoying actually. When you're trying to build a bigger position, it's extremely annoying actually. It's more than a 3x. LifeMD has more than 3x, and so right now I'm in a situation where I consider HIMS to be the better deal. HIMS is the better deal right now, because HIMS is just a little bit more expensive than LifeMD. It's not that much more expensive than LifeMD. And if you look at this video, so I did this video November 8th, 2024. Is LifeMD, better? LifeMD was about 4 times cheaper than HIMS if you removed Work Simply. That's what I had said in this video. If you removed Work Simply, LifeMD was about 4 times cheaper than HIMS back then, and it was trading at $5. You can see when I published that video, it was trading at $5. So now it's trading at $15. It caught up. It caught up. It was discovered by Wall Street, and now it is still cheaper than HIMS. It is still much smaller than HIMS, but the valuation I don't find as appealing, and the main reason for that is because they have Work Simply that messes up with their books. Work Simply grows too slow. And it just doesn't look good on that top line growth because of Work Simply. They need to sell that. When they sell Work Simply, they'll have a much cleaner story, and the market will grant them perhaps a valuation similar to HIMS. Perhaps. I think HIMS is a much better play right now, and HIMS is still very, very, very inexpensive at a 0.15. In that spike, that February spike, it went up as high as a 0.18. That's how it went on my metric, right? Enterprise value over gross profit over revenue growth. I've presented that metric many times on the channel. That's my spin on the PEG ratio of Peter Lynch, right? I modify it with my sauce using EV because enterprise value is much better than market price, market value. Using gross profit because I look at companies that are optimized for gross profit, and I believe, for example, as I think most 21st century investors should believe that marketing is an investment in the future. Marketing is not a cost that you never recoup. You recoup marketing because marketing is an investment in the future, right? So oftentimes accountants view expenses differently from investor. As an investor, I view marketing as a good thing. There's a trade-off between marketing expense and how fast you grow. The more you spend on marketing, the more you're going to grow. So anyways, that was a quick tangent. Right now, moral of the story, I like HIMS much better, even at 64. HIMS has not run as much as LifeMD, and yet they are in very, very similar sector. One slight difference is that LifeMD has spent a lot of time and energy trying to get insurance, and I think because of that, the velocity of the money, the velocity of the revenue at LifeMD is never going to be as fast as HIMS, because LifeMD sometimes has to deal with reinsurance on the back end, and with collecting insurance, and of course, HIMS doesn't have to deal with any of that because HIMS doesn't take insurance. Or as they say, you don't need insurance to use HIMS, is what they say, rather. It sounds better, fancier. Anyways, let's talk about Supermicro, SMCI. So this stock right now is I covered this, the audit committee, the accounting, rumors and all of that stuff. There was nothing wrong, nothing bad happened, but you still have the overhang, and the CEO is said 3, 4, 5 times everything's fine, and that overhang still lingers. So this is the accounting issue that wasn't in many ways Supermicro, and so it hasn't recovered to the way it was trading in early 2024. But in my view, the way it was trading in early 2024 was more right than not, which is SMCI. They got started with this thing called green computing. You'll see the CEO will make an interview in the forest, and they're all about green computing, and luckily green computing means liquid cooling. That's what it means, liquid cooling. So they build servers, they provide the racks, they provide the liquid cooling equipment for servers. And of course, what do we know about the way of computing? Computing is going liquid cooled. Look at all of the NVIDIA new products. All of the NVIDIA new products essentially require liquid cooled. If you look at the Jensen Huang presentation, some of them he says, oh, you can still use air cooling, but most of them are going liquid cooled. And so there's a few players that benefit. You have Vertiv, you have Dell, right? Dell is a big beneficiary. But if you want to have exposure to liquid cooling, in my view, there's only one pure play liquid cooling exposure, and nearly pure play, and it's Supermicro. Supermicro is gonna take a lot of that business. In fact, Elon Musk's data center in Memphis, it's half SMCI, half Dell, right? It's a good practice when you're a company to multiply your suppliers. SMCI is, in my view, gonna be one of these suppliers to anybody who's trying to get into the liquid cooling space. And of course, their products are well embedded with NVIDIA. The headquarters is right next to NVIDIA. Both CEOs were born in Taiwan in cities that are very much similar, and it's a whole, it's a whole form of doing business that people sometimes are not used to in the West, and that was part of some of the attacks against the CEO of SMCI. The short reports, I remember some of the short reports were saying, oh well, his cousin is working there, and so it's self-dealing. Well, is it really? Anyways, I don't really care if it is or not, but it's like to me, this stock is cheap. This stock is very cheap. It's trading at a 0.18. In the hottest space in the market, which is AI hardware. We're in the phase of AI hardware right now. That's one of the hottest space, and it's trading at 0.18. Forward revenue, price to forward revenue, enterprise value to forward revenue is 0.78. So that's less than 1, right? So that's very cheap. Adjusted EBITDA, EV over adjusted EBITDA is 21. This company is growing fast. I'm looking at the analyst numbers saying 63% revenue growth next 12 months. So, and of course the shocker, what's not as good here is the gross margin. It's 11%, but you're doing hardware at the end of the day. So in hardware, it's kind of the way it has to be. So anyways, I find this stock very, very cheap. And right now I consider it a good buy per my spreadsheet. Sometimes I have to stick to my spreadsheet and what it says. Let's talk about Nebius. Nebius is a stock that I covered twice on the channel. I think this was my earlier coverage or my second coverage. I can't remember. When I started covering Nebius, you see it was trading at 33. It's now trading at 47. So it's not as cheap as it once was, but it's still pretty cheap. And actually, you can see the valuation from back then. The AI hardware valuation from back then, you can see it's pretty high. Dell is trading at a 4, Avgo is trading at a 1. The hardware valuation is pretty high. This is one of the hottest sectors. So this is why when you have SMCI or Nebius trading under 0.5, it's cheap. You're getting cheap here. 0.33. So it got a whole third more expensive. The big question is, can Nebius get even more expensive? And of course, if you don't know, Nebius received a big NVIDIA investment. They're building data center. They have a core weave of Europe. But not only have they a core weave of Europe, but they also have a lot of investments. ClickHouse is one, AV Ride is another one. They have multiple VC-like investments because Nebius was founded by the management team of Yandex in Russia. When they founded Nebius, they brought with them investments that they had in all sorts of VC stuff, and now that's been collapsed into Nebius. So Nebius ends up owning, say, I think it's 28% of ClickHouse, which is a private company, which is worth something like $6 or $7 billion from what I can tell, and growing very fast. And so you have that VC aspect in Nebius, which gives you a margin of safety. And of course, you also have the raw valuation, which is they're building the data centers super fast. Predicted revenue growth is 333%, and they received a meaningful investment. I can't remember how much it was, but hundreds of millions of dollars of investment from NVIDIA. NVIDIA has a lot of investment in a lot of companies, but the big meaningful ones is not as many. And this one was one of them. And I think we have to value for a company like Nebius, the big tech CEO is what we have to value, because the CEO of Nebius used to be the founder and CEO of Yandex. And if you've been in tech for a long time, Yandex is known as the Google of Russia. So I think you're paying a lot of the strong ties of the CEO for Nebius, but really, are you paying really that much? When I calculate in my spreadsheet, not really. Of course, the risk. What is the risk in a company like Nebius? The risk is that I'm way off on revenue growth, right? What I don't think I am, but I could be. And if I'm way off on that revenue growth of 333%, 335%, then the growth would look very, very expensive. There is also a little bit of risk regarding the depreciation of these GPUs, right? These GPUs depreciate very, very, very fast. And so how profitable of a business is going to be? I think the consensus in the market is that it's going to be a pretty profitable business. If you can tell what's happening with CoreWeave, for example, some of the miners, the IRENs of the world, Riot yesterday that I covered, people are not as interested in those, but it's the same sector. It's the data center sector. I like that sector very much. I own Nebius. Now let's talk about two stocks that I don't own, but they've been the buzz lately. Everybody's been talking about OSCR especially. Clover not as much. People have not been talking about Clover as much, but I've seen on X Clover come up whenever OSCR comes up. So I've covered OSCR a few times on this channel. A few days ago I covered it as well. They are an Obamacare administrator, if you will. They provide Obamacare plans, Affordable Care Act plans. Sure, they're hoping for Part E of Medicare, and that could be a big business. And they're hoping to get into employer-sponsored insurance, and that could be the big business. But I would argue, I mean, it's not an argument. It's a fact. It's less established, right? Obamacare is way less established, and you always have that overhang of people saying the new administration is going to take it away or remove the subsidies, and the overhang makes the stock move whenever there's a rumor somewhere that says, oh, we're going to cut the subsidies. In OSCR's prediction of revenue growth for the next 12 months, for the next 2 years, they talk about, oh, this is how much revenue we're going to make with enhanced subsidies and without enhanced subsidies. And you're dealing with really low-cost healthcare with OSCR. And so, typically, do you want to be in a high-end business or a low-end business? Typically, I believe the high-end businesses make more money. If you're doing low-cost healthcare, well, that's not going to help your top line too much. But anyways, this is not the point. The stock is very cheap. Being objective here on OSCR, the stock is very, very cheap. I think it's too cheap. I think that stock is going to go up. The question is this an investment that I want, right? And for now, the answer has been no, because I believe that healthcare is going to get cheaper, but not thanks to companies like OSCR or not thanks to government subsidies. I believe healthcare is going to get cheaper because of companies like HIMS, who are fully vertically integrated and just compete like regular companies compete, because they removed insurance, they removed reimbursement, and as a result of that, the turnaround between selling the product and when you get reimbursed, that's 3 to 6 weeks in a traditional healthcare setting. For HIMS, it's right away. You put your credit card, you get paid. So that's kind of my take. Still too cheap, though. Let that be said, that it is too cheap. Clover, to be honest, so Clover is much more expensive than OSCR. But Clover, in my view, deserves to be more expensive than OSCR. And I actually probably like Clover much more than I like OSCR. So you can see. So first of all, Clover flying under a radar. You're at a 3x. You're at about a 3x in the past year on Clover. So this stock was entirely left for dead. OSCR, yeah, you had a spike because of the buzz of retail investors lately. I'm curious to see how long that spike is going to last. I don't have a stake in that stock, so I don't really know. But I know that Clover actually has done outstanding the past year. And Clover, what do? Well, they are trying to disrupt Medicare Advantage. But they're only in 10 states or 9 states or something like that. They are a Medicare Advantage provider. What is a Medicare Advantage provider? Well, in simple terms, in the world of government healthcare and in the world of getting subsidies to provide healthcare, the money is at Medicare. People turning 65 and over, right? I'm saying this for those who don't live in the US, obviously. But if you turn 65 and over, boom, you become Medicare eligible, and you have a choice. You can even either get your Part A or your Part B, and you can have what the government says you should have and just leave it as is, or you can say, I'm going to get a Medicare Advantage plan, which is Medicare Part C, and in that case, it's the private insurance that takes over and administers Medicare on behalf of the government for you. So your Medicare becomes administered by a Medicare Advantage plan, which is Medicare Part C. All of a sudden, you have Medicare Part C, and they add coverage like, a maximum out of pockets and all of that sort of stuff. Essentially, it's where the big money is in government-funded healthcare. And in fact, when I had a conversation with NAI, one of the biggest providers of this is United Healthcare and Humana, but especially United Healthcare. They are a huge provider of these Medicare Advantage plans. And of course, they own clinics. They own a bunch of clinics. And if you go to their clinics and you have your Medicare Advantage plan with United Healthcare, you're covered in the clinics, and that's kind of how they work with their care, and they're trying to disrupt that. So why do I like Clover better? Because we have an idea of the size of the market as far as market cap goes. The size of that market, that Medicare Advantage market, is in the hundreds of billions of dollars. It's hundreds of billions of dollars of market cap, and you have Clover, who's trying to disrupt that space with everything just like OSCR, by the way, AI, lean company founded in the 21st century, very few employees, very modern IT stack, your kind of classic disruption play, but they're trying to disrupt the old stuff. They're trying to disrupt the old guard who makes a bunch of money from Medicare Advantage plan. OSCR is really not trying to disrupt. They're a new player in the Obamacare world, and of course they were born at that time, right, when that became the new thing. So I think this is a much bigger market in my view, because not everybody will ever get government healthcare and ACA healthcare. Not everybody will ever get that, but everybody. I hope for all of us, everybody is going to be 65, and everybody is going to get Medicare when you're 65, and so that means that there's a lot of money to be made, because a lot of people are going to be like, okay, well, let me get the Part C, let me have that administered by a company where I can have a chatbot, where I can have better choices, etc., and that's where Clover comes in. And I like that they're pure play too. These behemoths like United Healthcare, Humana, they do so much. They're not pure play. They have a lot of very hard assets, especially United Healthcare. I remember coming from a channel. They own so much real estate. They own so much, so many clinics, like in the thousands, something crazy, the maintenance around that. And of course, telehealth is going to disrupt that, so I don't want to have that debt, right? That's not a debt I would be interested in owning. Anyways, moving on to two other stocks that I've covered before on the channel, DLocal and Stone. So especially Stone, right? I used to own Stone. I used to be a big fan of Stone. Unfortunately, I tax harvested Stone in December, because last year I had sold a house and I had a bunch of capital gains, and I don't like to pay capital gains, so I was looking for losses. And I had two stocks that were prime for harvesting my losses, and it was Enphase and it was StoneCo. So I sold Enphase and StoneCo in December, towards late December. Selling Enphase in late December turns out to have been a wonderful decision. On the other hand, selling StoneCo in late December was not a good decision, because it's up 80% since late December. StoneCo is up 80%. So flat. I guess the operation is flat all in all, because I saved losing money on Enphase, but I left money on the table on StoneCo. I feel bad. I like StoneCo very much. STNE, as I used to call it, as they call it. StoneCo is the leading payment company. You should never get attached to the stocks. So I don't really feel bad. I don't fall in love with the stock, but I had liked this stock. STNE was a nice stock to own. The one reason why I wanted to sell either STNE and Enphase, by the way, the same for both of them, is that their revenue growth has entirely stalled. Whether it was STNE or Enphase, both of these companies were growing well into the 30% per year. And, unsurprisingly for Enphase with interest rates, but I was very negatively surprised by the drop in the growth rate of StoneCo. And so for me, that's typically a reason to sell. Clearly, the market likes it in the stock price because StoneCo, as I used to make fun, StoneCo has been in the cash piling business, and they keep piling cash. That is what StoneCo does, and I didn't like that. I didn't like to see them piling so much cash and investing not enough in the business. But clearly, the market has rewarded those who have held StoneCo. So good for you. And about DLO, so DLO is a different story. So I used to own DLO a while back, but I sold it. And the reason why I sold it is because I got tired of the short reports. And this is true, by the way, for a lot of Latin American companies. DLocal was attacked. For like a year and a half, it was relentless. A short report after another short report and another short report. They had a bunch of short reports. If they drop the short, your stock goes down 55%. You think you own a company, that's fine. But, you want your company to be anti-fragile. If dropping a short report makes your company go down 50%, well, I don't want to be in a stock that is manipulated like that, even if I like the underlying business. So that's the reason why I would be careful with the DLocal. And I would not re-enter the DLocal position anymore, because what if there's another short report which out of nowhere releases the short report and then the stock reacts so violently? So anyways, that big spike you see, that was an example of a short report, right? But you see there's been more spikes on this stock just as a result of short reports. So anyways, I don't like short reports. But anyways, that's the point. Okay. Jack of all trades, commenter of the channel. He's gonna be able to stop commenting. Like the past 5 videos, he's been commenting on his stock, and he's like, "Oh, it's the best stock. It's the best stock." So let's cover and Jack of all trades. You've left more stocks in the comment section. I'm only gonna cover the 2 that I somewhat sort of agree with you, that are pretty cheap, especially for ZETA. I think ZETA is the more interesting play. The reason is because JEUVEAU, this is a very painful spelling for a French native speaker. Anyways, JEUVEAU, I'm not so sure I want to be in the Botox business, you see. I mean, I have some elf makeup is a leap, but do I really want to own a competitor of Botox, right? And the problem with these beauty companies, right? Oddity is another stock that I own. I haven't covered it in a while. The problem with all of these beauty companies, in my view, is that the filters on your phone are becoming so good, and life is becoming more and more digital. And we deal with a loneliness crisis. People don't really go out anymore. So what's gonna? And I'm talking about young people in general. And I guess this is more for an older crowd, right? Because you don't get frown lines when you're in your 20s, hopefully. So I really don't know. I mean, this is like the too hard thing. Do I want to be in the Botox business? Do I want to try to compete against Botox? Especially they don't seem to have an application for migraine. One of the big reasons why Botox used to be a great stock. They used to be owned by Allergan. It used to be a great story. That was the migraine thing, and they don't seem to have any of that. So I don't know if I want to invest in that business. Perhaps an idiosyncrasy of mine, because if I just stick to my spreadsheet, you're correct that it's cheap. But if I go into the healthcare space, there's products that I like better, like CorMedix, for example, which prevents infection. And then CorMedix is trading at 0.06 on enterprise value over gross profit over revenue growth. And I think it's a more useful product because it prevents infections in people getting catheters installed. And so anyways, that's a tangent again. The point is, not too sure when I've been in that business. ZETA, I like very much. Now, ZETA seems like a catch, and I might want to cover it for the channel. Stay tuned, I might want to cover it. They're a marketing platform, an AI marketing platform, cloud native, and they're growing a little low for me at 24%, but it's still growing fast enough, and they've upped their guidance. If you follow ZETA, I was reading the call and the PDFs, they've upped the guidance. So I like when a stock increases guidance, because then they could do up to 30%. And in my spreadsheet, I like to invest in companies that grow next 12 months at least 30%. But I like ZETA a lot. I like that it's a platform. I like that it's cheap. It's not that expensive. In the software as a service company or You know, it reminds me a lot of a trade desk. ZETA reminds me a lot of a trade desk, and the trade desk, of course, was one of the best performing stocks out there. And so what if that next leap is the marketing platform, a great AI marketing platform? Well, if that's ZETA, if ZETA becomes that, then the valuation will be much higher. So this is potentially a multiple expansion play, which is not what I do on this channel, but potentially we could see, I think, very much a large multiple expansion for a stock like ZETA, because it is a SaaS business, and SaaS businesses typically enjoy very high multiples, and currently ZETA does not have a very, very high multiple. I also like that ZETA is much more profitable than, say, JEUVEAU, which you recommended. It's only 1% EBITDA versus 18% EBITDA. So I think ZETA is much more profitable. The rule of 40 is there at 42. Granted, it's not as high as what I usually like, but it's still there, right? JEUVEAU doesn't achieve the rule of 40. So I see a lot of things that I like with ZETA. It might be prime for an analysis. Stay tuned, subscribe to the channel if you want to see that. And the last stock, which in every way is too risky for me, but I've seen this one in the comment section before. I've actually analyzed it for the Patreon a while back. I will release that video to the public soon. It's Branch Out Foods, BOF. Yeah, this one is way too risky for me. I mean, it's a $25 million market cap. Not even sure which broker it's available on. Yeah, forward revenue growth is excellent. They seem to be mostly doing a lot of business on these bell pepper crisps. And so, you know, this is kind of a JEUVEAU all over again. Do I want to invest in Botox for front lines? Probably too small of a business for me. And now, do I want to invest in bell pepper crisps? Probably too small of a business for me. But the valuation is cheap on Branch Out Food, so I'll give them that. And the rule of 40 is very high. But why? It's because I'm assuming 170% growth. If this gets lower, then the rule of 40 could easily get under a 40. And of course, there's many more stocks in my spreadsheet that I have. Some of the stocks I covered in the last video, for example, is CorMedix, Delcath, Biostem. You know, I like Biostem. I consider Biostem to be the cheapest of the cheapest. Out of all of the stocks I cover, Biostem is by far the cheapest. The second cheapest used to be OSCR, but OSCR has moved back to third or fourth cheapest now, and it's a Chinese company that's now ahead of OSCR. But Biostem is still the cheapest, trading at a 0.01. Under that, is trading slightly under that. CorMedix is also very, very cheap and a profitable company in a needed field and space. So anyways, this was just some of the stocks that I want to talk about today. There's so many, you know, these videos could last hours if I covered them all. So anyways, this was not financial advice. This is not investment advice. This is only entertainment. I hope you were entertained. Please like, please subscribe, follow me on Patreon, follow me on X. Thank you for watching, and have a wonderful, wonderful day.